All right, Paul, you're good.
All right, guys. Hopefully everybody can see me and hear me okay now. We had some technical difficulties. All right. All right, great. Okay. I'm hearing a little bit of an echo, so I'm going to turn my volume off. So if you guys have to get a hold of me, just text me. All right, guys. So we had a little bit of a technical issue. Can you guys shoot me a little message in the chat just to make sure you guys are seeing and hearing everything okay? But we're good to go now. So the class or the webinar is how to safely trade options in 2022. The agenda for the class today is we're going to go over the current state of the market. So even if you're not really that interested in options or don't know a lot about options, we're going to talk about the market, how we can swing trade it. And then from there, we're going to talk about how we can use options in a market like this, or in just about any market. We're going to go over one specific trading strategy that you guys are going to find really useful. Now, the class is an advanced options class, but the first day will be a review of some simple topics to get you caught up. So if you don't have background in options, you'll be okay. And then the option strategy we picked today to go over is actually pretty simple, and it's going to work really well for you guys who are swing traders as well. So it's definitely worth going over that strategy, really simple, and you'll be able to implement it right away. When we're done with that, we're going to talk about the upcoming options class, and then we'll have a little Q&A. All right, so before we do that, really super quick on who I am. I think a lot of you guys already know me. You've had some kind of contact with me in some way. I recognize some of the names. While we're in here, why don't you guys give me some shout outs while I'm talking so I can see who's in here. I see Craig and Kevin and Charles already. But I'm Paul Singh, lead swing trader at Bulls on Wall Street. I run the Bulls on Wall Street swing trading service. You guys probably know the head honcho here at Bulls on Wall Street, Kanal. I mentored him many years ago, back in 2005, 2006. He went on to found Bulls on Wall Street. I went full-time swing trading back in 2012. And in 2014, I started running the swing trading service here on Bulls on Wall Street. So that's a little about me. I use a top-down approach to trading. We always start with what's going on in the market. You're going to see that here when we go over what's going on in the market right now. I use a top-down approach, momentum-based strategy. For swing trading, we start with the market, then we hit the industries, the best stocks from those industries, or worse if we're looking to short. And then, of course, the setups that would apply. And overlaying that in this class will be options. But we'll still be starting from a foundation of this top-down approach. Okay, so let's get to it and talk about the current state of the market. First of all, we should be aware of the macro market news. Now, normally as swing traders, I really don't pay that much attention to what's going on unless there's something really significant. Last 2 years, it seems like we've had a lot more of that than normal with the pandemic, with inflation, now with a war. But these are things we should be aware of in 2022. And let's first start with the last thing I have listed here. And that's the fact, even without the war and inflation and rates and all that other stuff we've been dealing with, just in terms of seasonality and cycles, we're in a mid-election year cycle. And mid-election years tend to be not the best years for trading in terms of volatility. They tend to be very volatile, and they tend to be directionless. So, as swing traders, we like direction in industries, in the markets, in stocks. We want to see them going up or down. We don't care if we're bullish or bearish, but we want trends. And in mid-election cycle years, that's not always the case, especially from January to October, essentially until the elections. So the way the cycle usually plays out, we get this volatility, directionless volatility from January to October. October, November, December tend to actually be very strong. So it's interesting in this type of year, mid-election year, we tend to have a January to October that's not very good, tends to be volatile. If you look at the stats historically, they're weak compared to other years. But then once election's over, people don't have to worry about them. October to the end of the year tends to be stronger than normal. So if you're kind of thinking about how you want to, put your money, how you want to trade, probably less aggressive now, very aggressive once October, November, December hit. Now we have some other things that have kind of thrown a wrench in this. It has actually created more volatility. That is, of course, inflation, which was already starting, before the year started. Last year, we were already getting hit with inflation. And that inflation has ramped up because of the war in Ukraine, Russia, energy prices, commodity prices. That has all even added more to the inflation issue. So obviously that's having an impact on the markets. And then cycling in with inflation is the potential for raising of interest rates. And it's not even potential anymore. They're doing it. The question is how much they're going to do it and how does the war impact what they were initially going to do. This week is a big week for that. Powell's going to speak tomorrow and Thursday, and we'll get more information on that at least this week. But that's something we're going to have. These are four things we have to contend with this year. So what does this mean to the market? It leads to uncertainty, and the market despises uncertainty. It oftentimes it doesn't even care about bad news. How many times did we see through the pandemic where we actually got bad news, but the market didn't care and kept ramping up, right? If we look at SPY here, and here's the pandemic low, there was a lot of bad news through this run here, but the market ignored a lot of it because it could price it in, it understood it, it kind of knew what the future held after the bad news was over. Right now, we're in a state of uncertainty. We don't know what's going to happen with the war. We don't know what's the leader of Russia, what he's going to do, right? We don't exactly know what's going to happen with inflation. Everyone thinks it's going to get better, but what if it doesn't? No one really knows. And we don't know what the Fed's going to do. Exactly, right? And the Fed has said, while they've kind of given indications, they basically said we're going to adjust to whatever we see. So that doesn't give us any certainty. Market does not like uncertainty. It almost likes bad news better than uncertainty. So uncertainty leads to volatility. And if we see what we've seen in the market, not only has it gone down from our peak here back in early January, but it's been volatile. We've had these big moves down, we've had big bounces up. Those bounces can't continue. They go back down, and we kind of get this directionless volatility. Maybe we've got a little bit of a downtrend, but a lot of volatility here. These markets are difficult markets to trade directionally. And when we swing trade, that's what we're doing, right? We're picking a direction. We either want it to go up, we want it to go down. It's tough to play that volatility. That's why you hear swing traders, you hear me say this a lot. Common advice is patience, wait for the good setup. And that's what we have to do. It's okay to be in cash. It's okay to sit on your hands and then pounce when the opportunity arises. If you're not losing money when the market is going down, you're actually winning in a sense. So that's something to be aware of when you're in this volatile market. Now with options, there are strategies that actually help you get aggressive. And this volatility can actually be a good thing because there are option strategies where you don't have to play the direction, but you can play the volatility. And in the class, we're going to get really deep into that. How do we, in a situation where I don't know if the market's going to go up or if the market's going to go down, but I'm pretty sure there's going to be a lot of volatility. There are strategies where I don't have to pick the directions. All I need to know is the market is not going to trade in this range, and it's going to trade outside of the range. So we're going to go deep into strategies related to that. Now, in the previous options course, we delved into some of the strategies. We're going to talk about more strategies, and in the strategies we went over, we're going to get much more in depth and then how to apply it to these markets and actually trade it as well. Also, options can be very helpful in mitigating risk. And actually, the strategy we're going to go over today is a risk mitigation type of strategy. So you'll see that today, how you can use an option strategy that will mitigate the risk and allow you to trade even if there's uncertainty in the market. If you're not quite sure, you need to essentially protect your downside in a trade. And that's very helpful in a situation we're in right now where we have uncertainty. We don't know what's going to happen. There could be a black swan event or something crazy that could happen. As a swing trader, if we get this big gap down, we get crushed. But there are option strategies that can help mitigate that risk and make it much safer to trade. So, so we have an idea of what some of the news events that are impacting us. Now let's actually look at what's emerging in the patterns. And when I say the market, we're basically talking about the S&P 500, IWM, the Russell, and the Qs, which is the NASDAQ. So let's look at these three indexes. Essentially, we're seeing the same pattern in both of them. So we can just go over SPY and we're seeing the same thing. One of the things we're seeing here is a topping pattern that has developed. So if we look at the S&P 500 here, now look at it, look at where we were since the pandemic low. Essentially, we've been in this bullish continuation pattern, right? Notice here, we'd make big runs. We'd have natural pullbacks. These pullbacks are very healthy in a trending market. You want to see pullbacks, but those pullbacks were bought up very quickly. They weren't that volatile, and then they'd get right back on trend. And we see a lot of tests of the 50-day moving average, no tests of the 200-day moving average. Outside of this pullback in here, no real deep pullbacks, and everything was bought quickly. And look at the line here. Look at how the 50-day moving average was just trending up. Now notice here now, it has become very different. Not only have we broke down below the 50-day moving average, it did not get bought up and get right back on trend like it did here, like these tests did here. This one was a little scary, but still, very quickly emerged. Not the case here. Not only did it not get bought up quickly, it didn't even stay in a range. We essentially then broke down below the 200-day moving average, and then the next reflex bounce. Now we've got resistance, and at resistance levels, we start failing. And essentially here, there's two ways to look at this. We could see this as a double top, which is a topping pattern. Double top is where you make a high, you test that high, and then that high fails. And that's exactly what we're seeing now. We even have a bigger head and shoulders pattern emerging. That's when you have a high, you have a breakout over that high that fails, you have a bounce attempt. So think of it head and shoulders. This is the left shoulder, the top, and then the right shoulder, or the head, and then the right shoulder. Essentially, however you're looking at it, whether it's a double top or a head and shoulders pattern, we definitely see a topping pattern that has emerged here. So think about what we're seeing. We have this bad news, we have a war, we have inflation, we have the Fed raising rates, we have a mid-election cycle year. So the news is not good. And we've had bad news before, but before technically the market was still strong. For the first time, we are now seeing a weak market and a technical bearish pattern. And that's what we're seeing in SPY here. So essentially here, as a swing trader, you either want to be in cash, taking a few long shots or bounce attempts, or going towards a few relative strength areas that might be doing well inside a bad market, or shorting the bounce failures. And in the swing report, we've taken some shots at longs. We've shorted. We've definitely shorted some bounce failures as well. That's kind of been the go-to play for now. And then we'll see what happens, how the market. It's going to be really interesting to see how the market reacts this week after this Fed speak and what they say about interest rates, what they're seeing with inflation, and then if there's any news related to the war as well. So not a great market right now, right? So we have to be cautious as swing traders. But again, there are option strategies that work very well that mitigate risk, or just let you even profit directionally or through the volatility of what's playing out here. Now, we really don't need to go deep into it, but the Qs, essentially the same pattern, even worse. So tech stocks, growth stocks, IPOs also have been getting crushed. And then IWM, which is the small caps, we're seeing a weak pattern here as well. A little different than what we're seeing in SPY and the Qs, but weak nonetheless. A little stronger because some of the relative strength areas are heavily represented here, like energy and metals. So we see a little more strength in the Russell, but still pretty weak and definitely way off the highs. So that's where we are in the market. So essentially a topping pattern. Strength has been what we talked about. Strength has been sold at resistance. That's where dead cat bounce setups are, which is essentially, if you think of a cat, the old idea of a cat falls from a tree and then it just bounces, a short kind of bounce before it lands. That's essentially what's happening here, right? We have the bounce up higher, the fall, and then the smaller bounce, and then that leads to the secondary trend down. And that's where we want to be looking to short. It's tough to hold shorts for significant amounts of time because the bounces within these trends can be very powerful. So again, option strategies can be very helpful for this, where maybe as a swing trader, you would have to be cautious, but you can implement strategies, one, to either mitigate risk with the swing trade you're taking, and that's essentially what we're going to go over today, or you can actually create just full option strategies that help hedge your trade. So that's where we are in the market right now. Now let's look at some of the industries. So essentially here, even though we have a bearish market or a topping pattern overall in 2022, the Qs are down around 13, 14%. I think SPY is down 11 or 12%. Not quite sure where small caps are right now in terms of the exact percentage, but they are down as well. But we do kind of have a split market in the sense that there have been a few bullish areas. And those bullish areas make sense with what's going on in the world, essentially what's going on in Eastern Europe. So the bullish industries are XL. I have the ETF tickers here, XLE, which is energy. So energy, we all know, has been popping. We've seen it at the gas station. So energy has been bullish. XEM, which is metals, especially industrial metals, have been very strong. So that'd be copper, steel, even the precious metals, gold, palladium, platinum. All of these things have been strong. DBA, which is agriculture. Agriculture has also been very strong. No surprise here. XAR, defense, has been very strong as well. Europe is worried now. They see Russia as a threat. So Germany, they've been buying stuff from US companies, been very good for Lockheed Martin, Northrop Grumman, General Dynamics, and we can see that. Let me actually pull up some stock charts here. So here's XLE. You can see how strong it has been. So look at the difference. If you see SPY, you can see what SPY is doing. XLE, kind of the opposite, has started to pull back now, but has been very strong. And we can just pull up some energy stocks. There's MRO. Here's Oxy. If we look at defense, there's XAR. Not quite as strong as energy, but still a strong pattern and much better than, SPY has been going down like this. Defense has been going up like this. And now if we look at a few of the defense stocks, LMT has been on fire. General Dynamics has been on fire. NOC has been on fire as well. So very strong here. And we could do the same thing for metals. Here's XME, even precious metals like gold. You can see how strong gold has been as well. So these are the bullish areas in the market right now. That's essentially it. There might be some other small pockets and a few stocks here and there, but these are essentially the areas you want to be paying attention to the long side right now. And then bearish is essentially everything else, but some really bearish areas have been essentially growth, tech, software, cloud, IPOs have been very weak, have basically given up all of their post-pandemic gains. The ARK ETF, which is a lot of growth stocks, social media companies have been crushed, and big tech. So let's just look at some of these tickers. If you look at IGV, you can see here, this is software. Software, the ETF was up at 446, down to 309. And if we just take a sampling of software stocks, you'll see the extent of just how crushed some of these things are. So software has been very weak. Big tech has been weak. Let's just pull up some big tech stocks. And you can see here, Oracle just a little while ago was sitting at 105, now is at 80. Google, which has been relatively strong, still 3,100 down to 2,500. Even Apple here was at 181, is down to 155. We have Tesla here was around 1,200 down to 800. So these things have taken dips as well, but it's really the software growth type stocks that have been really hit the hardest. And that's essentially what we've been looking to short on bounces. So anytime these things bounce, let's just pull up a few of these stocks. I'll kind of show you the whole cycle. Here is Zoom. If you look at Zoom, here is the topping pattern that had emerged in Zoom, and essentially every bounce here has been a short opportunity. And now if we bounce here, we'll watch to see if we get another short opportunity in something like Zoom as well. And then we've had mixed kind of results in retail, housing, and financials. I'll just pull up housing here because housing is interesting in the fact that it might be topping. XHB is the ETF. And if you guys have any questions here, just shoot me a message in the chat. I don't see any so far, but if you guys have any questions, shoot me a message in here, or just say something here so I know you guys are getting it. But here's housing here. We see a topping pattern. Now, let's just go back to Zoom, and you see where there was the topping pattern and you had these first kind of bounces that were failing. But if we look at XHB here now, we're in the initial stages that maybe this is a topping pattern and this is a bounce that's going to fail. And you can see how much room there is to the downside. Here is the pre-pandemic level here. And you can see XHB is at 68. It has a lot of room to fall. If we just look at some of the stocks, here's Toll. You can see just how much room there is to fall. It's actually already testing its pre-pandemic level. Okay, all right. So essentially here, we have a few bullish areas, a lot of bearish areas. And this is the mindset you should have in terms of what industries you should be picking to trade. Now, we've talked about the market itself. We have a general idea what's going on in the market. We have a general idea what industries, what the big industries are doing, where we should be looking for potential bullish plays, where we should be looking for potential bearish plays. Now, let's talk about an option strategy that works very well in an uncertain market like we're in now, or if you know there's going to be a news event that you need protection from. You need protection to be able to hold your position. And that is the protective put. So let's talk about that. And if you guys, just to get an idea here, say yes or no. If yes, of course, if you've done one of these before, if you've done a protective put, and no if you have not. Okay, all right. So this strategy is a really good example of kind of a creative maneuver that you can implement using options that add complexity to your trading. Doesn't mean it's hard to do, but it adds complexity to your trading. That is not just a simple buy and hope it goes up, or sell and hope it goes down. With this, this is a directional play, but it's really limiting your risk. So, for example, if I buy a stock at 100 and earnings are coming up, a lot of the time, if I'm still sitting at 100, I'm going to get out of the trade because I'm worried. I'm just guessing going into earnings. If there was a 20-point gap down, I'd be crushed. If I had 100 shares, I'd lose $2,000. But what you can do is you can put a protective put on to cap your risk. You're going to give up a little profit, but what we'll do is it will say basically, you can say I'm willing to lose, say, $500. And I'm going to give up some of my profit, essentially insurance, but it's going to protect me. And I can hold through earnings then. Even if there was a big gap down, I would not get hit that hard. So this is an example of one of these creative maneuvers you can use to help you do some things that you couldn't do if you were just straight swing trading. So protective put, a form of risk control or protection during volatile times like earnings, political events, or uncertainty. It essentially caps how much you can lose. Essentially almost like a stop, right? But there's a huge difference. If you buy a stock at 100 and you put a stop at 95, if the stock gaps down to 80, you're not out at 95, right? You don't just lose $500 if you had 100 shares. You're getting out at 80 and you lose 2,000. The protective put is going to protect you from that. So it's a form of risk control, protecting you, caps how much you can lose, whereas losses with direct swing trade are almost infinite, at least where you would go down to zero. With a protective put, you can create a max loss. It essentially allows you to get aggressive when you might have reason to be worried or might not even take the trade. So protects you from kind of black swan events, some crazy event that happens. What if every once in a while you see like a FANG stock that goes down 30 or 40% on some crazy news? What if, in Russia, their leader came out and, threatened nuclear war or something? That would create havoc, right? If you have a protective put on, no matter what happens in the market, it saves you from getting crushed, essentially. All right, so let's go over how we actually do it. Very simple. First thing you're going to do is buy the stock that you were initially going to buy. So let's just say we like Apple. I actually don't like it here. It's below its 200-day moving average, but so let's just say we like it. Well, it actually came back. Well, actually, let's say we like the fact that it showed some strength, got back up above its 200-day moving average. We decide to buy it here. And you're going to buy in 100-share lots because your options trade in 100-share lots. So let's say we want 100 shares. So we buy 100 shares of the stock. Now, the second thing we're going to do is we are going to buy one put for every one of those 100 shares. A put is essentially a bearish play. We'll go more into detail on how these works in option class, but just know a put, if you're not familiar, a put is a bearish play in options. You're going to buy one put essentially against that bullish play on your stock. So you have one bullish play, which is the 100 shares you bought of the stock. And then your bearish play is buying that one put. Now, there's various ways you can do it in terms of strikes. And if you're not familiar with strikes, we really don't have enough time to go into it here. But for our strike price, we'll essentially put it at where the stock is trading right now. There's more creative things you can do, and we'll talk about that in the class. But for now, to keep it simple, buy your put strike price at the price the underlying is trading. So if Apple's trading at 155, you want to buy the put with a strike around 155. So for example here, let's just use round numbers here. If we buy 100 shares of stock X at 100, we're going to buy one put of that stock with a 100 strike. And let's say the premium on that, when you buy a put, you're paying for it. So the premium is at $3. So essentially what that's saying is we're buying that put, and the max we're going to lose here now is essentially $300. And the way we're figuring that out is by calculating our max loss. Very simple to do. You're just going to take your stock price minus the strike price plus the debit. And the debit is what you paid, $3 here. Your break even is the stock price plus the debit. And then your max profit is unlimited after your break even. And that might be, if this is your first time seeing this, might be a little hard to grasp. So let's explain it here. So you bought a stock at 100 shares of it. You bought one put with a strike price of 100, and your debit was $3. You're essentially paying $3 for it, or $300. Max loss. You always want to do this first. How much could I potentially lose? What's the maximum I could lose on this trade? And here we're taking our stock price minus our strike. And since our stock price and our strike price were exactly the same, that's going to be 0 plus the debit, which is 3. So essentially you could lose $3 on this times 100, $300. So think about that for a second. You bought a stock at 100. The most you can lose on this trade is $300. If the stock were to gap down to 90, you're still only going to lose $300. So that's why we're doing this, to protect our downside. Now, you're giving something up. You paid for this, right? You paid $300. So now we want to know where our break even is. How high does the stock have to go before we actually start making money, right? When we just buy a stock directly, if we buy it at 100 and it goes to 100 shares at 100 and it goes to 101, we've made $100, right? In this case, because we paid for that insurance, we don't start making money until we hit our break-even point. And in this example here, we're going to take our stock price, which was 100, plus the debit, which was 3, and that gives us 103. That is our break-even. So our stock has to go above 103 before we make money. So if it goes to 102, we're not making anything. If it goes to 103, we're exactly break even. Whereas we would have made $300, right, if we didn't have the option on. If it goes to 110, instead of making $1,000, we end up making $700. If it goes up to 120, instead of making $2,000, we make $1,700 and so on. Essentially, we're always going to make $300 less. That's the insurance we paid. And maybe it ended up being we didn't need it. It's just like car insurance, right? We buy it, we pay for it every month because if that disaster happens, we're going to need it. It's the same thing here. Hopefully we don't have to use it. And we just paid that $300. But if we do end up having to use it, it saves us a lot. And that's essentially why we don't need to put these on all the time. But there are certain times when you want to be doing that, right? If you're going into earnings, if the stock you're long, it has earnings on Friday, you love the stock, you think it's in a trend, you want to be able to hold it for the next 3 months, but you don't have to get out of it with earnings coming on Friday, put on a protective put. That way, if it did gap down, you wouldn't get crushed. That's a situation we can use it. or a situation where you're just worried about what's going on. There's uncertainty in the market. So right now, right, again, we have the war, we have inflation, the Fed is speaking this week. What if the market tanks? That protective put will protect you from any bad events that could happen. So essentially, you're paying a little to protect you against one of those big events that could lose you a lot of money. So that's the protected put. A couple of other things here. Manipulating your break-even point. You know, in the way we created it with the scenario we created there, we essentially paid $300. Now we could create it in a way where instead of 103, our break-even was 102, but then we'd get less protection. So if your strike, the closer your strike is to the underlying stock's price, the less it'll cost you, but the higher your break-even point is going to be. And then the farther strike is from your price, the more it costs, but the lower your break-even price. So that's something to think about. You know, you can always start standard by just using the same strike and the same strike as a stock price, and then you can manipulate it to see where you want your break-even. You know, according to look at the stock chart, see how far you think the stock can go, see how much protection you want, and so on. Okay, so that is the protective put. Again, disadvantage, major disadvantage to this, which is really not a huge disadvantage, is you're giving up a little of your profit, but you're not capping your profit. Once you hit that break even, you can make as much as the stock goes. You'll just always subtract what you paid for that protective put. Okay, all right. So that's a protective put. Hopefully that helps. You guys have any questions about it, let me know. You can shoot me an email and I'll get back to you. But now let's talk about the options class. Why should you consider learning and trading options if you're currently a swing trader? I think we've gone over this a little already, and you can see the benefits of at least this option strategy. It's great for supplementing your swing trades. It can protect your swing trades, as we saw with the protective put, via hedging. There's much more complicated strategies, and this is a very simple strategy that we'll get into. You can really do some cool things with these strategies. The other is leverage. You saw here, it only took one protective put to control 100 shares, essentially. So especially if you have a smaller account, you can leverage up. Or even if you have a bigger account, you can use a smaller portion of your account to gain leverage in a smart way. And we'll talk about a lot of smart ways to do that. You can manipulate your win rates and risk. So one, you can take control of your risk better than you would with a stop, as you saw with the protected put. Manipulating your win rate. You can create strategies where you have very high win rates that are great for income. Now, the strategy we went over here, protected put, because you're giving up some of your profit, that actually creates a lower win rate because you have to get up to 103. So that would be a lower win rate strategy. But there are strategies, income strategies that are what you could call income based, where let's say you need 5,000 a month or 10,000 a month. You can create high win rate strategies and try to control your risk with those high win rate strategies to do that. And then you can profit from volatile and range bound markets. So essentially there are strategies where we talked about this before. Let's say we think the market is going to go extreme in one direction or another, but we don't know which way, like going into earnings, or right now with interest rates, the Fed, the war, we might think we're not going to be range bound. We're going to explode, but one way or the other, you can create a strategy where you'll profit from volatility in either direction. You can also create strategies where you'll profit from a range bound market if the market barely moves or if your stock barely moves. So you can create strategies where, and this will be done with straddles and strangles, where you might say, I think the market is going to stay in this range. And if it actually stayed in that range, you think nothing's going to happen in the next month, you would profit from it staying in that range, and you'd only lose money if it goes out of that range. And you can manipulate how big and small these ranges are. So really cool stuff that you just can't do just directly swing trading with the options. So types of options trading, this is stuff where this is the way we have it broke down in the class. We're going to go over directional strategies where we are picking direction. And that's buying and selling calls, puts, spreads, and we'll do it in ways where we mitigate our risk. We'll go over income-based strategies, again, with income-based is basically high win rates, small wins, high win rates, covered calls, secure puts, various other spreads. Volatility-based trading, strangles and straddles, condors, butterflies, where we're picking volatility, not direction. And then we'll go a lot of hedging and risk management strategies, which are very good for swing traders who just, maybe you don't want to get that deep into options, but you want ways to protect yourself or manage your risk or hedge without just stops or having to place, trades against each other. And then we've talked about some of this already in some of the other classes, but we will go really in depth, much more in depth, much more advanced than we have before. And there'll be more strategies as well. Impact of time decay, impact of how long you're holding your option on these strategies. We talked about in the money and out of the money in the last class, but we're really going to delve into a deeper level understanding of how to use that to your advantage, whether you're going in the money or out of the money. All right, so that's essentially what we're going to be doing in the class. We will also be using options as a market sentiment indicator too, which you guys, we have some cool stuff with that as well. We've got the early bird pricing coming up. So I think there's a good deal right now this week, and Josh has got the links in here in the chat. If you want to look at that, there's a deal right now before it goes up. If you're in the swing service, we're going to be adding option stuff in there. You're already a swing member, it's just going to be in there. And if you're new, you're going to get access if you join the swing service with the options class. You're going to get a lot of the new options strategy information and examples and alerts that are going to be in the service as well. This is kind of what I already went over. Okay, lots of real-time examples, practical applications. As the class goes on, we're actually going to be putting these strategies on. So it's not just a class where you're just learning kind of esoterically this stuff. We're actually going to do it. And then the class is Sunday, March 27th through March 31st. Now, if you can't attend at these times, it's all going to be recorded, and you have access to me anytime. If you have any questions, contact Omar at omar@bullson.ws. You can contact me as well. And then again, here is the link to the early bird special, and I think you guys have the links in the chat. All right, guys, great session as always. We're going to do another webinar where I go over another strategy in about a week, and then the class will be starting up. If you guys have any questions at all, just let me know. All right. Thank you, guys.